Let's jump right into this explainer. Welcome to a space where cutting-edge science literally collides with the high-stakes, incredibly cash-intensive world of biotech finance. Today, we're walking through a survival guide for accounting in biotech firms. And look, this is an industry where you can easily burn, $50 million before you even know if your product works in mice. The clock is absolutely always ticking. So how do these life science startups survive that intense burn and actually keep the lights on in the lab? Let's find out. Now, while a standard business is usually obsessed with this quarter's sales and squeezing out immediate profit margins, a biotech firm is, well, it's a completely different beast. You are in a relentless race against your own burn rate during these massive pre-revenue research cycles. Your entire focus has to shift. You're tracking heavy R&D spend, you're managing incredibly complex clinical trial accruals, ensuring strict grant compliance, and constantly monitoring your cash runway. So, here's our roadmap for today. We'll be hitting the core biotech challenge, tracking R&D costs, diving into complex clinical trial accounting, managing grants, looking at burn rate and runway, and finally getting to those all-important investor-ready financials. All right, starting off with part 1, the biotech accounting challenge, or surviving the pre-revenue years. The core problem we're looking at here is fascinating, but also pretty daunting. Life scientist firms spend years and just incredible amounts of capital on scientific research, regulatory hurdles, and nonstop fundraising, all before generating a single dollar of actual product revenue. Because of that, basic bookkeeping just fails completely. It's not enough. You're juggling intricate R&D classifications, messy contract research organization or CRO tracking, and really strict grant reconciliation. Plus, you've got to document R&D tax credits and constantly report your burn rate. The financial activity here is so intimately tied to the scientific development that standard accounting simply cannot keep up with the level of detail you need. Moving right along to Section 2, tracking R&D costs, the lifeblood of innovation. Okay, so we're getting into our first real survival pillar now. It is absolutely crucial to separate your massive R&D expenses from your everyday general administrative costs. Under the US GAAP standard, research and development costs are generally expensed as they're incurred. And what makes this uniquely painful in the biotech world? Well, it demands rigorous, real-time tracking. Just think about the headache of trying to split a single lead scientist's salary between general admin work and pure lab time. I mean, that is something auditors absolutely love to scrutinize. You just can't throw all your expenses into one big bucket. Proper classification is what gives your founders and investors a truly transparent view of exactly how their capital is driving that innovation forward. Which brings us to Section 3, complex clinical trial accounting, navigating the chaos. Right, so if you thought internal R&D tracking was a massive headache, the billing chaos from CROs is honestly a whole new level of pain. You aren't just paying bills here. You're deciphering prepaid retainers, mid-trial milestone triggers, and these massive lag times that require heavy accruals. It's like a giant puzzle. You have to follow the money through this nonlinear chaos, actively tracking patient enrollment and clinical site payments all at the same time. If you don't master accruals in this phase, your financial statements are going to be completely disconnected from the reality of what is actually happening on the ground in your trials. Let's shift gears a bit to Section 4. Managing grants and funding, the rules of non-dilutive capital. Grants and government funding are essentially the holy grail of non-dilutive capital for surviving those long pre-revenue years. Basically, it means you aren't giving up precious company equity just to keep the lights on. But make no mistake, this money comes with some very severe strings attached. The strict tracking requirements are a huge burden. You have to isolate the exact grant award amount, prove out your eligible costs, and heavily manage restricted funds that can literally only be used for specific research. And just a quick warning here, poor grant accounting isn't just a minor administrative oops. If you mismanage these restricted funds, you can absolutely destroy your chances at future funding rounds and fail your audits spectacularly. But hey, all this meticulous documentation does have a massive silver lining, and that's unlocking IRS-qualified small business payroll tax credits. If you categorize your technical employees' wages and your research supplies properly every single month, you can actually offset your payroll taxes. It's essentially unlocking vital cash for your business. But here's the catch. You can't just wait until tax season to try and piece this whole puzzle together. No way. It has to be actively tracked as you go. All right, diving into Section 5, burn rate and runway, racing against the clock. I want to inject a bit of urgency into this right now because everything we've talked about so far really just boils down to the single most terrifying question that every biotech founder, board member, and investor is constantly asking: how long until the money actually runs out? Now, I know you already know the difference between burn rate and cash runway, but the real danger lies in how incredibly dynamic these metrics are during a trial. A delayed clinical milestone doesn't just, push your timeline back a bit. It compounds your burn and fundamentally alters your entire runway. Because biotech operates for so long before seeing any actual product revenue, highly accurate real-time forecasting isn't just nice to have, it's mandatory. And this is exactly where stepping up to a fractional CFO becomes an absolute game changer. It gives you that high-level strategic oversight needed to navigate the timeline right up to your next funding milestone, but without taking on the massive salary of a full-time executive. Finally, we've made it to Section 6, Investor-Ready Financials, Preparing for Scrutiny. So this is really where the rubber meets the road. All these moving parts we've been discussing, they have to coalesce into a flawless monthly close process. When you successfully reconcile your bank accounts and nail down those tricky CRO accruals, you aren't just doing basic bookkeeping anymore. You're building the exact documentation that's going to survive grueling M&A due diligence or propel your next crucial funding round. Even if you're years away from ringing that bell, this exact level of discipline is what actually builds real IPO readiness. As your firm scales, this simply needs to be your operational baseline. You've got to demand strict R&D cost tracking to support reporting and lock in those tax credits. You need proactive trial accounting to manage the absolute chaos of CRO invoices and accruals. You absolutely require laser-accurate burn and runway reporting to plan your fundraising safely before that cash runs too low. And having fractional CFO support is the key that connects all this incredibly complex data directly to your high-level strategic decisions. Which brings us to this final thought. Biotech firms need more than basic bookkeeping to survive the journey to market. Just think about the sheer complexity we just explored together, from chaotic trial invoices all the way to rigid grant restrictions. The stakes are simply way too high to treat your finances like some sort of administrative afterthought. So ask yourself, is your financial operation truly built to survive that long, demanding road to clinical success? Or, honestly, are you just guessing? Thanks for joining me for this explainer, and keep innovating.